Welcome, everybody. We have Ken Robinson with us today from Guaranteed Mortgage. Ken, how long have you been doing mortgages, Ken?
For about 13 years now. In my
So 13
past
years.
life, I was in the retail business. So I was a retail exec for well over 30 years before I got into the business with Patty. Patty's been in the business for over 30 years. She's run 6 different mortgage companies. So we make a pretty good team.
Oh, yeah. You guys are amazing. I think we've been using now for 11, 12 years?
Yeah.
Of the 13? So it's been a long time.
Always been good.
Yes. Yeah, it's been amazing. So thanks for jumping on board with us today and talking about what's going on this year in 2025 with mortgages. I know a lot of people have questions about interest rates, about requirements to purchase a home, just numerous questions about what steps should they take to get into a property. And so I thought this would be a great interview to kind of go over this. With that being said, I'm curious, Ken, what are interest rates like today?
Today they're just under 7, and so everybody is interested to see what's happening with rates. For the last 2 or 3 years, it was like it's coming, but it hadn't come yet. You know, when the Fed lowers its rate, that's short-term money, and they've lowered it about 0.75%. But that doesn't necessarily translate into any reduction in mortgages, because mortgages are based on the Treasury yield, and that's a long-term rate. So there's a lot of pressure on the new administration to get those rates down. So we'll just have to wait and see.
Gotcha. Do you anticipate they're going to change it all this year? Or?
No, I really think they'll come down. It's just that how much, how far, we just don't know that. A customer can also buy points to lower their rate by a certain amount, depending on what they're willing to pay. But you have to be careful with that. That's not always the best idea. A lot of times people just look at the rate, and a lender may have offered them a really good rate, but they didn't realize that they're charging points. 1 point is 1% of the loan. That could be $5,000-$6,000 or more, which did lower the rate. But on the other hand, that investment, it may take 6 or 7 years before that pays off, and you may not even be in the house for the next for maybe 2 more years. So depending on the buyer and what they're looking at in the future, and even at that rate, it's still a historically good rate. You know, I bought some land back in 2003 and it was 8%. Didn't bat an eye, because that was the going rate.
Yeah, and we're essentially back to normal. I think 2021 to 2022 spoiled us. That's something I try to educate a lot of buyers on is although affordability is a little bit lower, if you can afford to buy a home that you like, go for it, because you want to be in a position where you're able to refinance if the rates go back down versus being bidding wars with everyone else, right? So, I mean, in your opinion, is it still a good time to purchase a home, to get a loan for a home?
Yeah, absolutely. I mean, it depends. I mean, because first of all, it can take a long time right now to find a house, because it's still a buyer's market to a degree, and that's getting a little better, but there's still not a good availability of homes on the market. And so you can be looking for a long time, but if you find a house that's really your dream home, even at that rate, bad buy, because first of all, you're finding what you wanted. You're not still looking. You're going to take it off the market, and if rates do come down, have that opportunity to refinance if it's makes good sense financially.
Gotcha. And we talked about buying down the rate as well. Now, you said some lenders will sneak that into the loan without you knowing. And I've actually seen that happen. I've seen that happen and try to make sure that people are looking at their loan sheets before they pull the trigger. But on the flip side of that, you can also negotiate with your realtor to have the seller buy down your rate as well. What's your thoughts on that?
Well, a seller can end up, I mean, they could pay up, depending on the type of loan. You know, they may be able to pay up to 6% of the sales price towards closing. Sometimes that's better. You know, there's 3-2-1 buy downs or 2-1 buy downs where the seller has to contribute on that. And that possibility, but the seller's got to be willing to do that. But in a lot of cases, if you've negotiated them paying 6% of the sales price, you've accomplished the same thing.
Okay. So I'm curious, kind of changing topics right now. I'm still in the mortgage, but what products are you seeing for first-time home buyers with the rates being a little bit higher, essentially back to normal? Are you seeing any additional incentives for first-time home buyers to help get their foot in the door?
Not necessarily. I mean, because when you think about a first-time home buyer, that could be anybody. I mean, they may be able to buy conventional, they may be able to do FHA. It depends on where they sit with down payment, where their credit score is, what their debt to income is. So they could buy a house just like anybody else. But typically they're talking about needing assistance in a down payment or needing assistance in
Right.
closing costs, those kind of things. And we offer all the residential mortgages. We offer FHA, THDA, VA, USDA, conventional loans, refinances, jumbo, all those things we do. And we try to fit that to the best needs of the borrower. You know, for example, an FHA requires 3.5% down. There is an upfront mortgage insurance premium. So there's a few negatives to that, but it's the easiest loan to qualify for. Because there's just things like debt to income. An FHA loan will allow you to have up to 6.99% debt to income, just to be under 57% to allow you to get into a home. Whereas a conventional loan requires a debt to income of under 50%. And so those are all good programs. And again, depending on how long you're going to be in the house. But just a little tweak from the FHA is a lot of times thought of as a first-time home buyer program is the THDA. And the THDA is basically an FHA loan, but they also allow you to get up to $5,000 up to for down payment, and they help you on closing costs because there is a down payment required, but they do it for you, and there's no payment, no interest on the loan. They also offer 6% of the sales price up to 6% of the sales price towards that down payment and closing costs. And there is a small second mortgage on that, but it's very modest. So sometimes that can help the client get in. But on the other side of that is where the FHA, just a regular FHA, allows a 56.99%. The down payment assistance and closing, that kind of stuff is helpful, but they still want a tight loan. So they're looking for a debt to income of under 45. So if debt to income is an issue, they'll need to go with an FHA.
So talking about some of those 100% financing loans or down payment assistance programs, FHA, I'm sorry, not THDA, and then you've got USDA as well too. USDA, does that work similar to FHA?
It is. It doesn't have the same restrictions as a THDA, but the difference, it does require a debt to income of under 45%, and there's no down payment. So that's a good thing. The other side of that is a USDA loan has got to be approved by USDA. So you can go into the web under USDA TN or USDA GA and look and see, and you'll actually enter an address and it'll tell you whether it's qualifies. It's also called rural development. So that can be a good loan as well.
Gotcha. And if you guys are curious about where to find this information, you can go to our website, simplehousehunt.com, and check it out. And all that's on the webpage as well, too. So, Ken, I'm curious, what do you see? What kind of trends are you seeing right now that's shaping the 2025 market?
Well, right now, obviously rates, that's an issue and still an issue. But at the same time, it's still a buyer's market. So the housing availability is shaping the market as well. It is loosened a little bit, but, with it being a buyer's market, there's fewer houses on the market. They may ask for a little bit more, but as I said earlier, even at that rate, buying a house is still a good investment. I mean, houses were up 5% last year and they continue to go up in value. So you're building equity as you go. And then if you get the opportunity to refi, that's just a good thing as well. So, but all those things are factoring it. Whether the new administration is going to be able to put enough pressure to lower some rates remains to be seen. But there's a lot of hope in that because there's just a lot of people out there pushing to get homes moving and get this industry going again.
Gotcha. Now I get this question a lot, and I have people reach out to me all the time. They're like, "Hey, my credit score is such and such on Credit Karma. Do you think I could purchase a home? But I try to explain to everyone that the credit scores on Credit Karma, which is a Vantage score, is so much different than a FICO score. Could you elaborate a little bit more on that and explain how credit scores impact the eligibility of someone to get qualified?
Yeah,
And what
absolutely. You're exactly right. That's not your mortgage score. It's a different pool than a mortgage score is. In fact, you might see Discover, Equifax, Credit Karma, any of those online, but it's not your mortgage score. And it could be, it may be a 0.5% difference. It could be a whole percent difference. So you have to, the only way that you're going to know your mortgage score is for a lender to pull it. And the system really doesn't penalize you when a lender pulls it because it knows you're shopping for a mortgage. And you're encouraged to shop rates for a mortgage. But the only way you're going to know what your rate is or your score is if a lender pulls it. So by when you look at that mortgage score, and even people that say, well, let's just do a soft pull. Well, when you do a soft pull, you're getting the same score as Credit Karma. I mean, so it's not an absolute, yes, your score is high enough to qualify until the lender pulls it and verifies that. So all those are important, but your credit score is just a really key link in the home buying process, because your credit score is an indication of your credit worthiness. You know, how you borrow money, how you pay it back on time. All those things are factors. And obviously, if somebody's going to be loaning you money for a 30-year loan, they want to know that you're good to go. And so, I mean, there's other things in qualifying beside the credit score. Your debt to income's a factor, credit history, all those can play a role in it. But the main thing is that you need to get pre-approved before you start looking, because I talk to people almost every day that say, you know, I'm going to be looking in 6 months. Well, you could get to 6 months, so you let a lender pull it, and you're not even in the market yet. You've got a lot of history that you've got to fix. So that's important to start up front.
Yeah, it's imperative to get that pre-approval or pre-qualification, right? Which there's a difference between the two of those as well, too.
Exactly.
Especially before you start looking at houses, because you want to understand what type of house you're able to purchase. Now, the fear is, I know when I talk to people sometimes, is that they're so fearful that if they have their credit pulled, it's going to drastically hurt their credit. Is that the case as well, too? Or
no, like I said, the system is designed so that, you know, you're not going to be penalized. It's almost insignificant when you pull it for a mortgage, because it's not the same as buying a car or opening a credit card, those kind of things. Because that's the only way a buyer can find out what their credit score is for the lender to pull it.
Gotcha. Okay. In your professional opinion, because I hear this come across a lot as well too, people look at the purchase price when they're trying to get qualified versus the payment, right? Is it better to go off of, hey, I want to keep it at this payment amount and then figure out what that purchase price looks like, or work the other way around?
Well, it depends on their budget. I mean, they're the ones that can determine that. And we'll give them, you know, an option. You just tell us what you're looking at, tell us what your payment is, and we can back into whatever the house price that you can get. And any lender is looking at, you know, there's guidelines, there's debt to income guidelines. Like I said, for an FHA loan, you got to have a debt to income of under 56.99% or under 57. And so that's it has kind of guardrails, so you don't get too much into it, but it's still that personal choice. Where a conventional loan is, you got to be under 50%, and the THDA you got to be under 45. So those are guardrails on there, so that you just can't go and do whatever.
So factoring in that, especially when you're looking at the payment side of it, taxes and insurance, when you're trying to determine your payment, how does that affect what type of payment you may be looking to achieve?
Well, in most cases, most people escrow, and which is their taxes and insurance, become part of their payment. You know, in some cases on a conventional loan, they may be able to pay their own, but you know, with taxes, but again, that's, you know, the first thing, they need to get a good realtor. They need to have a realtor helping them go through this process, because that's important. Where they're going to buy, is that home going to, the value going to go up? When it comes time to sell, is that property going to be have appreciated? Those kind of things that a realtor can guide them on and put them in right properties, rather than spinning their wheels for a while. So with that being the case, the taxes, I mean, if they're in the city, I mean, if they're in the county, they're going to have county taxes. But if they're in the city, they could have city and county. So it could be double. So if they're just looking at a listing, they may not pick up on that. Sometimes the listing will show that, show the total, but sometimes it's not updated and it only shows the city taxes. So that's where the lender can come in as well. So those are important. The other part of it is your credit score impacts your insurance. So if you have a low credit score, you're going to be paying a higher homeowners for sure. So all those things are factors, and you need to talk through that because that's going to change your payment.
And people can shop around for insurance, correct?
Right, exactly.
For some reason, I know, I've been doing this a long time, but throughout the years, people are stuck on a certain insurance company when the reality is if they shop around, they can achieve a lower rate or a lower quote and essentially lower their house payment as well too. Right.
And sometimes they need to look at all of it because just like a good realtor, you got good insurance companies and good agents, and they're going to look out for your best interest as well. But sometimes it's so beneficial to have an agent locally that's going to help you versus something that's online and you're not really talking to anybody that's really going to help you specifically versus a local agent. So,
gotcha. Another question I've been getting lately too is fixed rate versus variable rate, right? So let me ask you about that, or adjustable rate. Let me ask you about that. Some people are trying to do an adjustable rate just to get a lower rate. What are your thoughts on that versus having a fixed rate over a 30-year period, 15-year period or so?
Right now, the fixed rate is really the best way to go. There's not, there's been times, I mean, I bought or built like 10 houses and at times we had a interest rate of 12%, but it was on a variable rate. So it's never going to be great, but it did help you get in there a little bit lower. And sometimes that works. And like I talked about a 3-2-1 buy down, that's become a little bit popular, but like I said, the seller has got to be willing to pay the concessions for the difference in payment. So that first year it's going to be 3% lower than, let's say it's 7. So it's going to be 3% lower than 7. And the next year is going to be 2. Next year is going to be 1. Then it goes back to 7%. And what that lower rate, how that impacts the house payment, that's got to be made up by the seller. So that's not always going to work either. And like I said, if you get that seller to pay 6% towards the closing costs, you're almost in the same thing. So it's the fixed rate is a good rate.
And in talking and buying down that rate again, I know we touched up based on this earlier. It still can't exceed the amount of the allowed closing costs for that loan, correct? So, for example, in most cases, FHA is up to 6%. In a lot of cases, I think conventional is up to 3%. Is that correct? Of the
on an FHA or even a conventional with at least 10% down, the seller can pay up to 6% of the sales price towards closing. On a conventional, if they go in with less than 10% down, then it can only be 3%. But that also includes title policies as well.
So all that is rolled into it.
I could get 3% of the sales price plus title policies in this area.
Gotcha. And that's for conventional with less than 10% down.
Right.
What is it for VA and USDA? Is that the same?
For them.
Okay. And then THDA is on top of that.
Yeah, the THDA, like I said, it's a program that allows you 2 programs specifically. I mean, there's also one for veterans, but they allow you either $5,000 towards the sales price towards closing and down payment, or with no payment, no interest on that loan for as long as you live there. But the other one is 6% of the sales price towards your down payment and closing. And then there is a small second mortgage on that.
Okay. I want to shift and talk about your company for just a moment, Guaranteed Mortgage. You guys have been around for quite some time. I want to know, what is it that sets you apart from other mortgage lenders, and how do you guys help clients get from start to finish? What does that process look like?
Well, we really have a great group. We came from a great group and we came to an even better group. We have all of our folks are very experienced. Our president of our company they're out of Buford, Georgia, but we have a joint venture with NewRez, and NewRez is like the 5th biggest in the United States and the 2nd largest servicer of mortgages. So we have a lot of experience, very competitive rates, closing, all those things. But one of the most important things is that you can reach us anytime. And just like, and all the times we've worked together, you can call me night or day, 7 days a week, because I know that buyer is looking to get in their house. And when it comes on the market, they need to be ready to go. And we're going to be there to help. And we're, you got some that fly at 20,000 feet, looking at the mortgage business, and these that are down in the weeds. And our group it's just right there on every particular client. We're going to make sure they get to the finish line.
Yeah, I'll never forget the one you did for me at 11:30 at night.
Yeah, that's just part of it. When you're working, I'm working.
Yeah, well, I appreciate that. I appreciate it. All you've done for myself and my clients as well too. Is it pretty simple to apply with you guys? Is it pretty simple to get the ball started? How would they contact you and get that rolling if they want to?
Yeah, if they'll, I like to talk to them, see if they have any questions, but then I'll get their email address and I'll send them a secured application link that they can complete. It won't take them long to do it. It's good when they do it because it's accurate. You don't have much chance of any transpose or things like that. And then from there we can roll. We're gonna check their credit, make sure they qualify from that standpoint. It's just a great process, and you're not having to come once you do that. You're also not having to come back in and sign documents and just different things. You'll sign your disclosures just like you would, but they're electronically signed. And so it's just a very smooth process all the way down to closing, where before you'd have to, in the old days, you go in and sign that disclosure, or you have to take sign it, fax it back, or send it back. And now it's all electronic signatures, and the closing is much quicker as well.
Gotcha. Well, Ken, I have thoroughly enjoyed having you on with us today. And again, guys, if you have any questions, tell them again how they can reach you, your phone, and also you can find them on househunt.com. But Ken, what's a good phone to reach you at?
423-902-6368. And again, you can call me any day, 7 days a week, anytime, and we'll get you information for you. And in most cases, when you call, depending on what your needs are. I mean, if you need it now, you're going to get it now. So we just like to be able to help buyers like that.
And I'm telling you, there's been some moments where we had to have that because of bidding wars or something like that. And we needed a qualification immediately. And we've had people that were maybe working with a friend or family member or something where they couldn't get a hold of their lender over the weekend. And you were able to provide us with a qualification in the door. So it's imperative that you are able to get a hold of your lender at any point in time during the transaction process, because having a lender who doesn't communicate can make the whole deal just horrible.
Got to have a good lender and got to have a good realtor, because those are the keys.
Absolutely. Well, Ken, thank you so much. Okay. I've enjoyed having you, and looking forward to working with you on more deals and helping people accomplish the goal of buying a home. Thank you so much.
Talk to you later.
Yes, sir. Thank you.